A woman stands outside a locked bank door in February 1933, her passbook clutched in one hand, her rent money and her husband's burial fund gone behind that glass. She is not alone. Behind her, a line stretches down the block, teachers, farmers, shopkeepers, all holding the same paper, all discovering the same truth. The money they thought was safe never was. Right now, the cash sitting in your checking account is protected by federal law, up to $250,000. It wasn't always. For over a century and a half of American banking, if your bank failed, your money simply vanished with it. And by the time the story reaches its end, you'll understand why it took a catastrophe of almost unimaginable scale to change that. Banking in America had always been a gamble dressed up as a service. From the earliest state-chartered banks of the 1810s through the national banking era after the Civil War, a bank could open its doors, take your deposits, lend that money out at will, and if too many loans went bad or too many depositors showed up demanding cash at once, the bank simply closed. No federal backstop existed. No insurance fund stood behind your savings. The government regulated how banks were chartered and how much capital they needed to start. But if a bank collapsed, depositors were treated like any other unsecured creditor, standing in line behind bondholders, waiting months or years for pennies on the dollar, if anything came back at all. This wasn't a rare event. Between 1863 and 1933, thousands of American banks failed. The country weathered major panics in 1873, 1893, and 1907, each one triggered by the same fragile mechanic. Banks held only a fraction of deposits in reserve, lending the rest out to farms, railroads, and businesses. That worked fine until fear entered the equation. The moment depositors suspected a bank might be in trouble, they ran to withdraw their cash before their neighbors did. And because the bank never had enough cash on hand to pay everyone at once, the rumor of failure became the cause of failure. A single whisper could empty a vault by lunchtime. By the 1920s, small rural banks were failing at a staggering pace. Nearly 600 a year, even during a decade often remembered as prosperous. Farmers, hit by falling crop prices after World War I, defaulted on loans, and the thinly capitalized country banks that held their mortgages went under one after another. Officially, the 1920s were the Roaring Twenties, a decade of jazz, stock speculation, and expanding credit. In reality, rural America was already living through a slow-motion banking collapse that most of the country chose not to notice. Then came October 1929. The stock market crash didn't sink the banking system by itself, but it triggered the fear that would. As the economy contracted, businesses failed, unemployment climbed, and depositors everywhere began asking the same question: is my bank next? And once that question spreads, it answers itself. Bank runs cascaded through 1930, 1931, and 1932. Nearly 9,000 banks failed in the 4 years leading up to 1933, wiping out roughly $1, $3 billion in deposits, a figure that would represent tens of billions today. Entire communities lost their life savings in a single afternoon. Businesses that had kept payroll in local banks couldn't pay their workers. Farmers who'd sold their harvest and deposited the proceeds watched that money disappear before they could buy seed for the next season. By early 1933, the panic had become self-sustaining and total. Governors in state after state declared bank holidays, ordering banks to close their doors just to stop the bleeding. On March 4th, 1933, the day Franklin Roosevelt was inaugurated, the American banking system was, for all practical purposes, not functioning. Depositors couldn't get their money. Banks couldn't extend credit. The entire circulatory system of the economy had seized. Here's the part most people get wrong. The popular story is that Franklin Roosevelt swept into office and championed deposit insurance as a cornerstone of the New Deal, the bold reformer saving the common depositor. That's not quite what happened. Roosevelt was actually opposed to federal deposit insurance. So was his own Treasury Department. Roosevelt worried that insuring deposits would reward reckless bankers and punish careful ones, forcing well-run banks to subsidize their poorly managed competitors through insurance premiums. He called the idea, in private, unsound. The real force behind deposit insurance wasn't a president. It was a congressman from Alabama named Henry Steagall, chairman of the House Banking Committee, who had watched rural banks in his own district collapse for a decade and refused to let the idea die. Steagall attached deposit insurance to the broader banking reform bill and effectively dared Roosevelt to veto a measure that had overwhelming public support in the middle of the worst banking crisis in American history. Roosevelt signed it, The Banking Act of 1933, what we now call Glass-Steagall, created the Federal Deposit Insurance Corporation, and it happened less because a president believed in it and more because a single legislator refused to let the public's fear go unanswered. The FDIC opened for business on January 1, 1934, initially insuring deposits up to $2,500 per account, a figure that has been raised more than a dozen times since, most recently to $250,000 after the 2008 financial crisis. And the effect was almost immediate. Bank failures, which had numbered in the thousands annually during the early 30s, dropped to a small handful per year almost overnight. Not because banks suddenly became better managed, because depositors stopped panicking. When people know their money is protected no matter what happens to the bank, they don't run to pull it out at the first rumor. And a bank run, it turns out, is one of the few financial crises that can be cured simply by convincing people it won't happen. But insurance didn't eliminate risk. It relocated it. Every dollar the FDIC guarantees is backed not by a vault of cash sitting in reserve, but by premiums collected from banks themselves, and, when that fund runs short, by the backing of the federal government, meaning ultimately by taxpayers. This is the trade the country made in 1933 and has lived with ever since. Individual depositors sleep easier, while the broader public absorbs the risk of the system as a whole. It's a trade that was tested again in 2008 and again in 2023, when Silicon Valley Bank collapsed and the government moved within days to guarantee deposits far beyond the official insurance limit. A quiet admission that the promise of 1933 had, by necessity, kept expanding far past what Congress originally wrote into law. What's rarely discussed is how close the entire system came to not happening at all. Had Steagall not tied deposit insurance to a bill Roosevelt needed passed for other reasons, had public pressure not been so overwhelming in the spring of 1933, the United States might have entered the mid-20th century the same way it entered every prior banking panic, with depositors bearing the full weight of a system they had no power to control. The safety net you don't think about every time you deposit a paycheck was never inevitable. It was the product of one congressman's stubbornness colliding with the worst banking collapse the country had ever seen. Picture that same woman outside the bank in 1933 one more time. Now imagine her walking into that same branch a year later, in 1934, and seeing a small sign posted by the teller's window, the official emblem of the FDIC guaranteeing that whatever happens to this bank, her money will still be there. It's easy to walk past that sign today without a second glance. It hangs in nearly every bank in America, small, unremarkable, easy to ignore. But it exists because a country learned, at devastating cost, exactly what happens when it doesn't.